James, how do I price in a trade war?
I don't think you should. I think that's the first thing I would say, is that I don't think at the moment we should be looking, quite that far into the future and quite into such aggressive tit-for-tat responses. I like to look at who's incentivised to do what and try and build base cases around that. And I would look at the sort of bilateral surplus for China, deficit for the US in terms of trade and current account.
But Matt's just making the point. The White House knows that BMW is the biggest exporter of cars from the United States, not to the United States, from the United States. And yet the president tweets about German car makers. Incentivised doesn't necessarily, the economic incentive doesn't always translate into the politically desirable.
No, but also the words and actions in the intermediate stages are not always indicative of the end goal. So I'd argue that because President Trump tweets about, firing or becoming militarily active in North Korea doesn't mean that that's the goal. That means that that is an attempt to get to the negotiating table, and that actually has been relatively successful, at least relative to potentially other approaches. So again, for me, this is about the fact that as Steve Mnuchin, the Treasury Secretary, has said a number of times, the US still believes in free and fair trade, and I would argue that there are a number of trading relationships and policies and processes around the world which are not necessarily in keeping with free and fair trade. And I believe at the moment that this is a US attempt to try and encourage other trading partners to engage in more free and fair trade. The fact that we're talking about IP, I would again look at what came out of China this week, earlier in the week, when we heard from Li Keqiang at the end of the MPC, and he talked about a number of freeing measures that they could engage in response to what's going on at the moment, including this issue of IP transfer into Chinese corporates when multinationals want to base themselves there. That's exactly what these policies are aimed at, and it seemed to me already that a desirable response had emanated from China. Now, obviously, there have been other sources speaking since which have maybe sounded a little less conciliatory in that respect, but I think we should have become used to by now the ebb and flow of communication, and the fact that where we end up is not necessarily demonstrated by these early skirmishes.
No, and we see, James, the same thing out of Europe. Earlier last week, Juncker was saying maybe we should think about lowering EU tariffs on U.S. goods. He didn't say that's as an olive branch, but clearly that's what Europe is aiming for. Some of the calmer voices in Europe are aiming for as well. Does that mean you think that this is a buying opportunity? On a day like today, when we see 541 stocks in the Stock 600 down, I would guess on concerns about the possibility of a trade war, do you go in there then and buy?
Yeah, I mean, again, there's a lot of stocks down and a large percentage of the index is down, but the magnitude by which these prices have moved, certainly in equity terms, is absolutely, noise. It's irrelevant in the grand scheme of things. If you see equity indices down 0.5% or 1%, that's quite large relative to the volatility that we saw in 2017. But I think, pretty much everybody agreed that the volatility we saw in 2017 was an aberration. That was not normal, and actually that wasn't healthy and that wasn't natural. So I think now we're seeing more normal-looking markets where they do marginally respond to news flow, and that means an ebb and flow of prices in the short term, but it is not necessarily demonstrative of where we're heading. So is it a buying opportunity? That depends on how you're positioned and what your time horizons are. But do I think equities are a good investment at the moment? Yeah, absolutely I do.
It's interesting. You mentioned the volatility. We have NIL Arian on the terminal. You could see Mohammed's columns, and he wrote the most recent one on volatility, saying basically be prepared for higher levels of volatility. Do you disagree?
No, absolutely. I agree. I think I may have been on this program earlier in the year and said exactly that. I think at least pockets of intense volatility, I think, are likely to be a part of the landscape for the next year or so, because what we've got to do now is go down the other side of the policies of the last 5, 6, 7 years, and that is to say central banks are no longer providing limitless liquidity, and the Federal Reserve first and foremost, and other central banks latterly, are beginning to sort of take away the punch bowl, to use a well-coined phrase, and that, by definition, I think, means that we must have more volatility. That doesn't mean permanently higher implied volatility. That's not really the way that that index works because of the way that it's constructed. But in terms of realised volatility, I'd expect the average level of realised vol this year to be much higher than 2017. And I think we will see, days, weeks and months where those volatility levels will look relatively concerning. But again, I think that's almost inevitable given the changing liquidity conditions, what we're seeing in LIBOR OAS spreads and cross-currency basis, treasury supply, fiscal deficits being expanded in places, these trade policy headlines that we see. There's a heck of a lot going on.